Good morning, everyone. Hope you're doing well and you're looking for some gems with the recent October sell-off. This video will explain why I believe QXO could be worth between $30 and $40 a share within the next 12 months. That's roughly a 50 to 100% upside. With the sell-off yesterday of about 6%, that's even more, as you can see, about 60 to 120%. The company sells roofing and other building materials, and the new leadership team is looking to transform that industry. Let's look at why this matters and why this particular business could deliver outsized returns. First, leadership. Brad Jacobs isn't new to this model. He built XPO Logistics from a small platform into a $10 billion transport network through disciplined acquisitions and tight integration and stuff like that. Before that, United Rentals, he grew that, and he then sold United Waste for over $2 billion. So basically, he understands how to consolidate fragmented industries and to extract value from scale. Second is the industry itself. It's in a tailwind. The distribution of building products is still run by hundreds of regional players using legacy analog systems. Margins are thin and data visibility is poor, exactly where Jacobs wants to come in, improve it, new approaches, and leverage that basically. Third is the valuation of the company. It's currently trading at roughly 12 times EBITDA with double-digit growth and a credible margin path. QXO trades at a discount basically to every peer that has already had this model proven. So in short, if execution lands as planned, that discount should narrow pretty quickly. So after acquiring Beacon Roofing Supply, QXO instantly became one of the largest distributors in its segment, the largest listed one anyway. Its approach is to keep the local customer relations, but run the back-end pricing, logistics, and procurement through a modern technology platform. The execution is pretty key here, and it's the main story. The team has done this before: buy, integrate, standardize, and scale, and they're flattening management and basically going through and fixing a load of old systems, rolling out new pricing systems, linking branch level data, decision making, stuff like that. Getting rid of bureaucracy and everything, which sounds exactly what the company needs. So onto the numbers. So this is how the company stacks up. On revenues, it's roughly mid-pack, so smaller than the private giant ABC, but comparable to SRS Distribution. Margins today sit around 10%, but management is targeting 15% as integration and pricing systems take hold. So this slide actually just brings everything together. What do these numbers actually mean? At today's valuation of around 12 times EBITDA, QXO trades near 19, or actually it's less than that, it's about $18 a share now, with yesterday's sell-off. But in short, what I mean is it's not priced for any margin expansion. In the base case here, a modest improvement in operational efficiency, margins rise from 10 to, let's just say, 12%. So management hits 50% of its target. That would lift the fair value into the low 30s, right? So that's 60% increase in share price value. If the full execution scenario where margins reach the mid-teens, like 15% or something like that, and there's a few smart acquisitions, which of course Brad loves doing, lots of acquisitions, he loves doing that. The valuation supports a share price of between $38 to $40, right? $42 actually. Roughly a double from here, 120%. What's notable is that actually aligns closely with what analysts think are going to happen. So on the right here, you can see all of the different firms with their, expert analysts. And generally speaking, analysts can be quite conservative, when they're putting out their calls. Pretty much all of them are saying overweight buy, which is obviously a pretty good sign, considering the company is still way below that. And as you can see, the price targets are clustering the same ones as I've calculated, $36 to $38, with high estimates around 40. So both the market data and the research community point to the same conclusion. In short, if management delivers margin expansion, earnings accelerate and the multiples re-rate. That's the path from a discounted distributor to a re-rated platform. Every investment does have risks, and for QXO, two mainly stand out here: execution and the housing cycle. So on execution, integrating hundreds of branches and bringing customers on into like a new digital system takes some time. Any delays could limit margin gains. And secondly, on the macro side, if there's weaker housing and remodeling demand, which I don't think there is, that would naturally slow volumes. In short, QXO story works if the rollout stays on track and if the housing market stays stable. In short, I think housing demand is going to continue to grow in the US, to be honest, but it's good to point out the risks here. And then anyway, let's just summarize this just to wrap it all up. So this is what makes QXO compelling. It operates in a massive fragmented market that's still largely offline. It's led by a team that's done this before, building billion-dollar platforms, standardizing legacy businesses and stuff like that. The valuation leaves a lot of headroom. If margins rise, that's the share price is going to adjust. And beyond valuation, I really like the fact that this is a diversification story, a tech-enabled play in a real economy. Lastly, guys, if you found this video helpful, please make sure to like, subscribe, and share. Please remember that none of this is investment advice. Always do your own research before making decisions, and I'll see you on the next deep dive.